Okay, let's look at the S&P 500 to start off the day. We are above all the moving averages for the S&P and for most stocks right now. And you can see that we are remain overbought. And right now we're approaching one of the most important earning seasons of the year, or earning weeks of the year, where we have the Mag 7 reporting their earnings. Let's look at that. Hold on. You can see that on Wednesday, it's kind of Super Wednesday. We have Microsoft, Amazon, Meta, Alphabet. And when we look at our our chart, we are overbought. So this leads me to believe that even if all of the earnings come in really great, then we're going to sell off because it's buying the rumor, sell on the news. So we're overextended right now going into earnings season. So don't be surprised if your favorite tech stocks report better than expected earnings and perhaps say that they're going to spend more on AI and their stock goes down. So don't be surprised with that because that's the way it usually happens. But I'm invested for the long term. So I'm only doing this kind of guessing what's going to happen to the stocks just for positioning my next trade. So so it's pretty dangerous right now to buy stocks when we're at all-time highs and everyone else is buying and we're overbought. So you have to do the opposite of what everyone else is doing, basically. All right, so let's look at this past week. This past week we had earnings from Tesla. Um, their guidance disappointed and their stock went down some. We had Intel report, and their earnings were better than expected, and their guidance was much better than expected, and their stock went up over 20%. We'll check out Intel's earnings report. Look at their estimates and see if it makes sense as an investment. We had Procter and Gamble. They reported earnings and they were better than expected, and they went up a couple percent. GE Vernova. This has been in our top, our stock screen for quite a while. And you can see that the PEG ratio is lower. We've been highlighting this stock for quite a while, and it had really good earnings, and it went up over 13% for the week. So we'll go over to GE Vernova again um, and see what's going on with that. What else? We had Capital One and American Express report, and they both went down on their earnings. So I think it's a good time to look at what's happening next week. Next week, we're having Coca-Cola coming out on Tuesday. These are big stocks. I like to keep track of the big stocks that'll move the market in a way. Uh, Coca-Cola tells you a little bit about how consumers are spending. We have Visa that tells a great deal on the economy and how people are spending compared to last year at this time. Then we have Wednesday. It's the mega earnings day with the four of the seven mag, four of the six mag seven stocks, four really big companies reporting: Microsoft, Amazon, Meta, and Alphabet. And each one of them has ran up into this week. So Microsoft is, it's kind of the only one that's kind of down for the year. So we'll see what happens there, but they're definitely going to move the market. On Thursday, we have Eli Lilly, MasterCard, Altria, and Apple. This is kind of the one big tech stock reporting for that week. We have SanDisk and Western Digital. Um, and that basically is what's happening in the next week. Okay, so S&P is up 1% from the last week. It seems like it was much more volatile than that. It went up and down a lot. And ended up 1% for the week. You can see that we're gaining momentum in the stock market. We have 52% of the S&P above the 50-day moving average. We know when we have a lot of momentum when it's over 70%. So it went up from 32% to 52% on the 50-day, and we're at 54% on the 200-day moving average. So we're getting a lot of momentum. We have people that were fearful turning into greedy, and that builds on itself, and there's a fear of missing out. So a lot of times the earnings reports that are coming out will help us get from 52 above, 54% above the 200-day moving average to higher than that if the earnings reports are good. But we all know that the big tech stocks are going to be spending a ton of money on CapEx, which is capital expenditures. And that kind of freaks the market out sometimes. And even though that their earnings reports will be good, there's going to be fears that they're spending too much and there won't be customers for all this spend that they're making. So, but Apple actually isn't in that category. Apple decided not to spend a lot of money on AI infrastructure, AI build out. They're using Gemini from Google for their AI products. So let's see if see what happens in this coming week. All right. Okay, so we're coming out of April into May, and you can see May. April has been a decent month. Now, May is actually a very good month also. It's usually up 1% for the year. And we have a very low volatility for the month of May also. So the VIX is usually trading down low. You have to keep in mind that traders go away for the summer. And because of that, you have vacations. People um, aren't as focused on trading so that well, we have a seasonality where the summer months aren't as good in the stock market. So you got to be ready for that as an investor. And um, that is, and then we have heightened volatility around September and October. So you can see that the VIX usually is a higher amount during September, October times. So you got to be ready for volatility during the August, September, October months. Okay, let's look at the S&P. You can see that we're in a trading range in a sideways pattern going back, it's almost a year now, close to a year. Um, and we kind of broke out of that just a little bit. You can see that, but right now we're overbought. So you can see that we might go back into this trading range. And the reason why we go over this is 90% of stocks follow the S&P 500. So if we can somehow predict what's going to happen with the S&P 500, we can time our purchases of new stocks with, whether we're overbought or oversold. Right now, you can see we're overbought. So this is not a good time to buy. You want to buy whenever all these stochastic signs and MACD signs are at a low. So for me, I'm 100% invested at all times. I do have money coming in every now and then to invest, and I use these charts to time whenever I put the new money in. So right now, it's not a good time to put money in, so we're overbought. And another signal we use is the short-term oscillator, S&P short-term oscillator. Right now, it's 7.37. That is overbought. Let's see what that translates to. Overbought sell signal. An S&P short range oscillator value above 5 or exceeding plus 8 suggests the market is overextended to the upside or due for a pullback. Okay, so we're at a stage right now where the stock market is kind of excited, happy buying. And we're approaching a big earnings season, which is a catalyst to go up or down. So it's time to be cautious. Let's look at um, let's look at the U.S. Treasury, the 10-year. You can see that interest rates have been going down for the 10-year Treasury, and there's an inverse correlation with the S&P 500. You can see the S&P 500 has been going up as the yield for the 10-year has gone down. Okay, so let's look at some of the variables affecting the stock market. We have the price of oil gone up. It went up 11% since last week. And we have an ongoing issue with the Strait of Hormuz being closed. And that definitely affects the price of oil. And oil has a big effect on the input. It's the biggest input cost to the stocks in the stock market right now. And high oil usually is inflationary, meaning it's a big cost, an input cost in every business, and businesses usually are not as companies that are not oil companies or energy companies are not as profitable with higher price of oil. We saw the inflation rate go up to 3.3% recently. So it was 2.6, 2.4. So it seems like tariff pressures and rising oil costs are causing inflation to go up. Um, so there are some companies that are affected by this and some not. Um, but we have to keep that in mind because inflation is very important. Because if you had $1 million last like 10 years ago, um, you would at this you would lose 3% every year for the past 10 years in buying power for for your dollar. So now you'd have like $850,000 of buying power from that million dollars you had 10 years ago. So it's very important to keep this inflation number in the back of your mind that your investments now have to earn at least more than the current inflation rate so that you can buy as much as you can now 10 years from now with the money that you have. Okay, let's look at the dollar index. It's unchanged since last week. Price of gold is down 3%. And there's no correlation between those two this week. Usually, a stronger dollar tends to drive gold prices lower, but we didn't have a stronger dollar this week. So let's look at the dollar index. It's kind of going sideways. It's not really going to affect the earnings for the multinationals that we're watching. Um, we've had a good situation for the dollar. It's been going down for the past five years or more, and that's helped the multinational companies. But now it's kind of neutral because we're going sideways. The fear greed index. We are at greed right now, and the translation is take some profits off the table or don't buy. That kind of correlates to our stochastics, where we're overbought in almost every one of our categories of stocks. Okay, so an individual investor has switched from bearish to bullish this week. So translation, take some profits off the table or don't buy. So you have to think as a contrary investor when you're putting new money to work and whether you're deciding to sell your existing or buy new holdings. And right now, the market is bullish and it's setting up for um, a letdown for these amateur investors because usually whenever the whole market is bullish, it's it's the time to start selling or don't buy. All right. Okay, and for the VIX, we're now at 18. That is pretty low. So we have the fear has basically it's leaving the market and we don't people are not buying protection. So let's look at the fear there are emotional graph for investors. Right now, we're at greed levels. So right now, we have a lot of people that are excited about buying stocks, and we're having some good earnings reports so far this year in the stock market. Earnings reports have been very, very good, and that's leading to a situation where people are buying stocks to go along with that. Also, in the S&P 500, we've had earnings estimates go up. And at the beginning of the year, there was a 14% estimated earnings increase, and now we have a 17%. So that is that is making the people on TV talk positive, and people buying fear of missing out. So let's look at the sector performance for this year. You can see that the energy sector is still the best sector. We have materials, industrials, real estate, consumer staples, utilities, and IT is like the one of the lowest. It's at 8%. We have the healthcare sector and the financials still doing poorly. You can see that financials and healthcare, they continue to do bad. Um, let's look at the worst performing sector from last year. We have energy, consumer staples, and real estate were the worst performing sectors last year. And now energy is turning out to be a better sector. And consumer staples and real estate are they're doing pretty good. The worst performing sectors are healthcare and financials. And these also correspond to the least um, valued. They have the least. They're the best valued stocks in the stock market compared to history. The highest valuation in the stock market are the industrials right now. They're at a 92 percentile, so they're really rich in price, and that could be due to a bill that was passed for construction and also for AI data um, infrastructure spending. And look at this. IT is actually 50, it was at 99 percentile earlier this year, but now it's down to 55 percentile. So it's becoming one of the least expensive sectors in the stock market. That's pretty amazing switch. All right, so let's look at, all right, I like to look at this every now and then. 125 years of market history tell a simple story. Stocks and earnings move together with a 98% correlation. The short run is all about noise, and the long run is about the profits. That's why every week we go over earnings estimates and earnings, because in the end, stocks usually follow the earnings. Um, so speculators chase noise and investors follow profits. So that is something to keep in mind. All right, so let's look at some of the stocks going up and down in the stock market. Okay, so we know from the 10-year has been going down. So if we look at our translation, yields of the 10-year going down, that's positive for technology, small cap stocks, high yielding stocks. Let's look at that is happening today with our sectors. We see the sectors going up the most are technology, oil, gold miners, telecom. Okay, so as the yields for the 10 years goes down, that is good for high yielding stocks. So we have telecom, that's high yielding. We have utilities, that's high yielding. And we have technology. It's positive for technology because um, technology companies can borrow more money at lower costs. And let me see, let's look at the sectors going down the most. Regional banking, healthcare. Okay, healthcare usually pays a dividend, so you'd think that they would go up in a declining interest rate environment. Home construction, it's going, it's usually goes up whenever the interest rates go down, so I'm not sure why that's happening. Biotech, they're heavily indebted, so they would benefit from a lower interest rate environment. All right, that was a good exercise. Let's look at the stocks going up and down the most. Intel, they had a really good earnings report on this past Thursday with great forward-looking guidance. And basically, that pulled, whenever one stock goes up a lot, that makes all of the stocks in that sector go up with it. It's kind of, that's the way things work. So these stocks didn't have, the stocks like AMD, Qualcomm, they didn't have the same news that's good, but they went up in sympathy, it's called. All right, so we have, what other stocks? Let me see. We have Baker Hughes, that's an oil related company. We have K-Late Tencor, they do equipment for manufacturing of the chips. And AMD, these are all chip manufacturers there. We have Newmont, which does gold. We have ServiceNow. We talked about it last week. That's like a dead cat bounce, it's called. Dead cat bounce is whenever a stock goes down 80% for the year and they go up just a little bit. Um, that's what that is, it seems. And we have SanDisk, they're another um, memory company. All right, let's look at the stocks going down the most. Charter, Comcast, HCA, Boston Scientific, eBay, L3 Harris. I don't see, oh, okay. I see a couple of stocks in here. Um, CF Holdings, CF Industries, they do fertilizer. So they ran up a lot based on the Iran war, Strait of Hormuz. And because that's kind of de-escalating, they could be going down because of that. We have, mm, okay, I don't know anything about Charter, Comcast, but I do know this sector has been going down for quite a while, and it's like a no touch. Right now, they have very good valuations. They have like a low peg ratio, but they're losing customers. Comcast is losing customers, broadband customers to maybe competitors like T-Mobile and Starlink. What else can we get in these top 10s? Okay, I don't know anything about these. Okay, that was good exercise. Let's go back to our talk. Um, okay, let's look at Dan Now's picks. Um, you can see Nike is down 30% so far this year. That is pretty amazing for a blue chip company. Um, we marked it as overvalued for quite a while. I thought it'd be interesting to go over Nike, um, just because Dan Now's liked it. See if it makes any sense. I looked at their earnings projections. You can see that they're growing from last year to this year at negative 18%. That's really bad. And from this year to next year, they're growing at 41%. You can see this average estimate. I divided 2.47 by 1.75. That got me that 41% growth. But then again, from 27 to 28, they're estimated to lose 3% in the earnings. So that is very inconsistent. Um, their forward PE is 23, and I can't really make a peg ratio out of that because right now we have negative earnings here, and then we have 41 PE, and then we have a 41 growth rate, and then we have a -3 growth rate. So it's just too inconsistent for me. It's hard for me to value this stock, and they have a lot of competition. They have Lululemon, they have um, Hoka, they have a lot of companies that are startups that are taking market share from them, and then the profit margin isn't that great. It's half of what we're looking for, and they have 8 billion. No, they have 4 billion in debt, which is very small compared to their market cap. But still, all in all, this is just it's a turnaround story. I don't want to get involved with that. I don't know what Dan Niles was thinking at that time when he bought this, but let's stay away from that one. All right, so let's look at our the chart in the video. You can see that been in a trading range for over a year. And we're at the top end of the trading range right now, going into one of the most important earnings seasons, weeks of the earnings season. So right now, it seems like we're in a zigzag pattern. You can see we're going up, up, zigzag, zigzag, zig. We're at the top of the zag, and we either go down to here or we break out. So based on this earnings season, if we break out of this, then chances are we'll go much higher. Otherwise, we'll just be in this same trading pattern. The reason why we're following these patterns is if the earnings end up being good and it didn't match expectations as well, it's going to go down to the bottom of this trading range. And that's the time you should buy it versus it when it's at the top here. So you can see we're overbought, you know, in all the indicators. So um, we'll go over NVIDIA a little bit later. And okay, this is our screen for this week. You can see that Micron and GE Vernova, we've been highlighting these for a couple weeks now as the top stocks in our screen. So I thought it'd be interesting to go over these stocks again, just because estimates change. We have reports that come out that are different. Um, this news story came out this week. Here's why GE Vernova stock power surged again this week and is up 75% in 2026. Um, their stock went up 14.6% this week after reported their earnings. The company's power and electrification solutions made it a leading player in the build out of AI infrastructure, and the latest earnings report confirms it has many of years of growth ahead. They have a lot of backlog orders. So their CEO said they wasted no time in their earnings to declare the good earnings of the quarter. In the last 90 days, we've added 13 billion in our total backlog and are now expected to reach 200 billion in backlog in 27 versus their previous expectation of 28. So they have a high demand for their gas turbines that they make for the AI data centers, and they have a big backlog of orders. Um, so that's what's powering that stock. Let's look at GEV and their numbers. Right now, they're growing at like 55%, and their PE ratio is 77. You can see it's 77. That's pretty high PE ratio. And so their PEG ratio is 1.4. If you divide 77 by 55, you get 1.4. That means they're 40% overvalued or 1.4 times overvalued. Um, but their profitability is really good. They have a profit margin of twice what we're looking for. Return on equity is like 4 times what we're looking for. And they don't have a whole lot of debt. They have 6 billion in cash, and they make 9 billion in free cash flow, which is they're a very profitable company, but they're a little bit expensive right now. Maybe after the earnings estimates come in, it might be less expensive. So we'll check in with this later on. Um, I'm going to check in with another one of these large cap growth funds this week that are top performers. This is a JP Morgan US GARP Growth at a Reasonable Price Equity Fund, JGISX. Let's look at what it's holding. NVIDIA, 12.6%. Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, MasterCard, and Alphabet. That looks like a lot of the other mutual funds. Um, so that's interesting. Let's look at because the earnings are coming up pretty soon. NVIDIA is the last to report in a couple of weeks. But let's look at NVIDIA because right now they're at a decision point in their graph. You can see that NVIDIA is right here and they could break out or maybe go back down to the bottom end of this trading range. Let's look at see if they're what their stock's really worth. Okay, their stock is right, it's growing around 31% this year. Um, no, it's growing at 71% this year. So their forward PE is 25. So if you divide 71 by 25, that means it's about a third of the price it should be. So that the PEG ratio is 0.36. So it's around 64% off. Um, so that means if you multiply the price by three, that's what it should be trading at. Its profit margin is three or four times what we're looking for. We return on equity, that's like 8 times what we're looking for, which is really good. They have 50 billion in cash, and they're using this cash to buy stakes in companies right now. They're making a lot of money and they're investing in companies, and that's not really um, that's an added bonus that could pan out later on as these stocks that they invest in appreciate in value. Let's look at the free cash flow is $60 billion. That is a lot. So this stock is like a third the price it should be. The one problem with this is we don't know if there's competition that's going to start eating their lunch. We have Broadcom making deals with Google, Apple, no, Google, Amazon, a lot of the big Facebook, a lot of the big companies. They're we don't know if they're going to continue to make money at this rate. So we'll see. You can see that CFRA says that they're a strong buy, and let's read their investment risk rationale column. This is very important. Our strong buy reflects expanding total addressable market, edge device penetration, and software opportunities. We see demand through calendar year 2027, aided by AI agents, physical AI, sovereign AI, expansion. Agentic AI has arrived with agents achieving useful intelligence, driving profitable token demand. Software capabilities and annual chip cadence support competitive moat. Um, okay, so that is the thesis. And the fair value, they say it's undervalued by 37.58%. Okay, so they think the fair value is 286. So that's a good double check on our estimates, of what it's really worth. And you can see the earnings are basically going up in a straight line, which is good. We had some um, sketchy times up to the year 2023, but you can see it's taking off. It's almost doubling every year. And that's what we like to see in a growth stock. Let's look at the Morningstar. And they say the stock is 30%. Its price to fair value is zero point 0.7, which means it's around 30% off. And the big thing about Morningstar's comments, they say that their fair value is increased because they have a $1 trillion forecast at their conference that they recently had. Okay, so let's look at I like to look at mutual funds and ETFs to see what they're holding because sometimes they have more resources than us, and sometimes Sometimes they have some good ideas and sometimes they don't. So let's look at their this M. It's the ticker symbol is VLUE. It's an ETF that's supposed to be investing in value stocks. And so let's look at the top two holdings, Micron and Intel. And the interesting thing about the top 30 holdings of this mutual fund is a lot of them have very low PE ratios. So if you look at the PE ratios, we have 6.5 for General Motors. We have Verizon with a 9 PE. And of course, we have Micron with a 9 PE. Um, we also have Comcast, which just went down a ton this past Friday. So when you're value investing, you're buying stocks that are cheap, but sometimes they're cheap for a reason. And Micron and Intel, they fluctuate a great deal because um, the demand for chips historically has been hot and cold. And we don't know when that's going to switch from right now, it's super hot, but we don't know when it's going to switch to super cold. So you got to be willing to wait through all the super cold times. Um, let's look at some more of these holdings. Okay, we have, well, yeah, I guess the thing that has everything has in common is very low PE ratio. Um, okay, so let's look at the top two holdings here, Micron and Intel. Okay, Intel just had an earnings report this past Thursday, and their stock went up like 24% to a record high in earnings. And I thought it'd be interesting to look. We've been looking at Intel, and it's been really sketchy. Their earnings for the past 10 years. Sometimes they have negative earnings, and sometimes they have positive, and it's very inconsistent. Let's look at their fundamentals. You can see that from this year to next year, they're growing around 40%, but the year after, they're going to grow their earnings negative 2%. Maybe this will change in the coming weeks after their earnings report, but right now, that's pretty inconsistent. They grew 202% from last year to this year. Let's look at their profit margin. It's -5. Their return on equity is -2. Okay. And their PE is sky high at 161. It's just there's too many missing pieces here for me. They have negative free cash flow. It's Warren Buffett would not be interested in this because it's not consistent enough. And um, okay, although it went up 24%, I can't see a reason to buy it right now. Okay, that was a good exercise. But you can see that, the stock has been in an uptrend here, and it was in the 20s, believe it or not, at the beginning in July of last year. And now it's look how it jumped out of there of this trading pattern. So it's whenever you see a stock that goes up like that, you got to say I missed it, and you can't chase it because right now it's not going on fundamentals. If you ask me, it's going on. This is probably a short covering rally, so it's pretty dangerous. All right, let's look at what CFRA said just for kicks. Like me, I had a hard time valuing the company. I couldn't even say what its fair value was because it had negative earnings and negative estimates. So CFRA very similar. They had not available for their fair value. So I can't get a warm fuzzy from CFRA to see what it's really worth. And let's look at what Morningstar said. They said they have a fair value estimate of 60, which is around 20% below where it's at now. So it's overvalued and its economic mode is none. So I don't know. I don't see a margin of safety for this stock. So that's why I'm like, I'm going to have to pass on that one. Okay, let's look at the second stock on this MSCI Value Factor ETF. It's Micron. Let's look at that again. I like to look to see if any of the charts or estimates have changed. And you can see that we are at the top end of this range. It's been going up, and you can see that we're overbought. So the time to buy Micron would be more like when it's down to here in the chart. So we're in a zigzag pattern. We're starting this downward from here. Um, let's look at to see. Let's look to see the fundamentals again to see if it's any of the reports have changed. Okay, so we can see that these are the earnings estimates from the beginning of the year in January, and these are the earnings estimates now. This is the biggest estimate revision of the whole stock market. It went from 28 to 29 growth from 114% up to 362%. So that is pretty big. And that accounts for most of the earnings. This is like half of the earnings revisions increase of the whole stock market. That's how important this is. And right now, the trailing PE, the forward PE is only 8.5, which is extremely low. And if they're growing at 362% and their PE ratio is 8, that means their PEG ratio is 0.02, which is 42 times undervalued. You can see the profit margin is 4 times what we're looking for, and return on equity is 39, which is 4 times what we're looking for. And they have more cash than debt, so that is really good. So let's look at what Morningstar says about it. They said the fair value is right where it's at right now, and they don't have any economic moat, according to Morningstar. The key debate for investors remains how long this cycle lasts and how high it goes. We expect a peak between 27 and 28, but now anticipate it will be significantly higher given the immense momentum price growth. We still expect a precipitous downtrend thereafter in 2029. So this is a boom and bust sector. Sometimes you have a boom like right now, and maybe like they say in 2029, it'll be a bust. So all these stocks will like go down a lot according to them. And they're saying that their earnings report blew them away. Let's look at what CFRA said. And this is the most important because I think this report, CFRA's report, is much more accurate. They have a buy rating with a $500 price target right where they're at right now. They said their buy reflects valuation and belief memory space will grow throughout calendar year 2027. We expect resilient pricing fueled by AI capex and high bandwidth memory wafer needs. High bandwidth memory total addressable market projected to grow from 35 billion to 100 billion. That's a 40% compounded annual growth rate. Um, Micron is engaging in multi-year strategic customer agreements, providing revenue visibility. So that boom and bust we just talked about for this sector, they're trying to settle that a little bit by having multi-year contracts. So if you get some kind of news that comes out that says, um, let's say Google invented a way that you don't need memory anymore, they still have these contracts in place. So that kind of steadies their growth for the next couple of years and the money coming in. So the company signed a 5-year agreement reducing cyclicality concerns. U.S.-based position provides advantageous amid advantages amid trade dynamics. Okay, so if there's a problem geopolitically with Taiwan or China, then this company will be kind of away from that. All right, so here's the most important thing about this CFRA report. They said analysis of the stock's worth based on their proprietary quantitative model suggests that Micron is undervalued by 336%. That means the fair value is 5 times what they're trading for now. That is pretty big. I've never seen that big of a value disparity, I mean, ever. So let's look at their earnings. Their earnings are pretty sketchy if you go back a couple years, but that's that you get, I think they call that the fleas that comes with a dog. This industry is a boom and bust industry. You have sometimes there's a great demand for the product and sometimes there isn't. But right now we have a lot of demand in AI infrastructure, and it seems like it's going to continue, according to Morningstar, at least until 2029. So, um, okay, that's something to keep in mind. All right, so, all right, let's look at this chart of fears again. And we had a lot of different major events in the past 100 years. And every one of these major events ended up being a blip in the mark. And we were talking about that just as we had this Iran war starting. And we're back at all-time highs right now. So you have to really take news stories, especially geopolitical news stories, with a grain of salt because they might not affect stocks as much as you think they do. And in the long term, that will be most likely just a blip on the long-term chart of the stocks and the indexes you're following. Okay, that is my talk for today. I hope you enjoyed that, and um, I'll see you next time.